George of the jungle, strong as he can be.
George, what happens if I do purchase a house on seller financing, leave the underlying mortgage in the seller's name, and the seller ends up getting into financial trouble? That's a great question. Welcome to thecreditjungle.com today. This is George Anderson, and let's just go into this a little bit. We've been teaching a lot more classes on the seller finance this year, and we've been getting some really good questions from people, and here are some answers. So we're going to go through some of that. Let's just take an example here where we've got a $600,000 purchase price. The buyer's putting down $70,000. They've got a significant investment into this property. They're going to have a contract finance amount where they owe to the seller $530,000. But the seller only owes $450,000. So who's got equity in this transaction? Well, both the buyer and the seller actually have an equity position here. So obviously the buyer's equity is their $70,000 that they put down, the difference between what they owe and what the value of the home is or the purchase price. But the seller also has some remaining equity in this home as well. They have a contract finance amount where the buyer owes them $530,000, but they owe the bank $480,000. So what do we got here with this little sliver of $80,000 of equity here? This is the seller's remaining equity in the property. And what happens if the seller, after selling the home, gets tax liens, judgments? I mean, there can be anything on there of public records that could technically cloud the title, okay? Whose equity does that affect? Well, if the contract was done correctly, and it doesn't matter whether this was a contract for deed or an all-inclusive trust deed, okay? Both of them basically have, there is public record, okay? Where the notice of interest serves the same thing as if there had been almost like a second mortgage, or in this case an all-inclusive trust deed that was recorded against the property. And what that does is that, let's just say that we came in there and there was a $100,000 IRS tax lien that came in, and the IRS was going to go ahead and enforce it, okay? They can only come after the seller's portion of the equity, okay? So that goes on there. It does not affect the buyer's equity because their equity was established at a earlier date, a prior date to this, which is why on these seller finance closings, we get title insurance. We do a settlement statement, a HUD-1 settlement statement. And in a case like this, this would almost be a case for having a lender's policy of title insurance for the difference between the amount here, because there's already a lender's policy on this that the seller paid for, but the buyer could purchase additional title insurance, a lender's policy for this $80,000 here to cover this gap for the insurance. But in reality, the IRS is smart enough too. They're going to come here and look at this and they're going, well, wait a minute, we can't get enough equity in this, and in order to foreclose on the seller's interest on this, we'd have to take the buyer out of the transaction, and it's very unlikely that that would happen. But even if it did, they can't recover anything more. So the seller's equity, or the buyer's equity in this one, is still intact. So probably didn't go into all of the legal terminology for it, but I'm not a lawyer and I'm not attempting to be one. But Jax has taught this in class, and this is a good protection for the seller as long as that notice of interest gets recorded or the all-inclusive trust deed gets recorded. So thanks for coming into thecreditjungle.com today. This is George Anderson, and push button, get mortgage professional, and I would be delighted to answer any questions you have about this, unless they're really a specific legal question, and then we send you to Jax. So have a great day. We'll talk to you soon.